Good day and welcome everyone to the UTI Market Insight for the month gone by for October and outlook on fixed income market going ahead. This month was very eventful for the fixed income markets. In the beginning of the month, we had a very tragic uh, escalation between uh, the two countries, which is Middle East tensions in Israel and Palestine. We also had the Bank of Japan policy, which was quite critical for Asian currency movements and its impact on broader bond market. We also had a lot of Federal Reserve speaking engagements, which could have impacted the view going ahead again for broad bond market as well. So we will discuss how each of them went and what's their impact and how we assess the market going ahead. If we look at the global economic activity, which is represented by JP Morgan Global Manufacturing PMI, which is on the left-hand side of the chart slide, broadly it continues to remain soft as the extraordinary demand, which was generated because of the stimulus post-COVID, is now rotating to services, and hence we are seeing slowdown in goods demand. That's also reflected on the right-hand side, as we can see in the global trade and output volumes, which is industrial production, ex construction, and broad trade volumes. So broadly, manufacturing activity continues to be soft since the calendar year 2023. Coming to the commodity and food index, which has a large implication on inflation. If we look at the commodity, complex, as we saw on the previous slide, as the global volume as well as manufacturing has been on the softer side, what it broadly means is that the commodity, the whole complex, whether it's industrial metals or precious metals or oil, they're all waiting for a more sustainable narrative or a more sustainable trend, whether we are moving towards a substantial growth path ahead or we are moving towards the slowdown. Since there is still considerable uncertainty on that side, largely the commodity markets are taking cues from very near-term drivers, which is broadly your shift in rate expectations, which are again dependent on near-term inflation drivers, also depending on the dollar movement, as well as data from China, as China continues to be one of global leading commodity importers. If we look at on the food side also, while food prices have gone up since the lows they experienced in June of 23, they still continue to be well controlled for a while now, and we expect them to be range bound barring any major weather related disruption. If we look at how the trajectory of inflation globally has been, as we could see in the previous two slides earlier, given the softness in manufacturing, given the way commodity prices have been range bound, now inflation has continued to moderate on the base effect as well as on the normalization of supply chain. As we can see in the right hand side of the chart, the last readings of inflation across the major economies has been much lower compared to their peaks which they saw during last year. However, the journey towards their target levels will be more critical for the central banks to act on policy easing. And hence, the thing to watch out for inflation would be whether the inflationary trends continue to show decline towards their target levels for most of these major economies. As we can see, the 10-year sovereign yield movement in key economies, we saw a major rise in bond yields during the month of October, largely, while we discussed various factors in the beginning of the on the discussion. One was, of course, the major geopolitical escalation, which also led to concerns on commodity prices and inflation view going forward. The second being the data coming from the US as well as other parts of the world continue still to be quite robust, leading to concerns that central banks have to keep rates much higher for longer till they see confidence on inflation before acting upon any easing. And also, one of the major reasons for rise in bond yields this time was also concerns on U.S. fiscal. Um, for a long period of time, market participants have assumed a certain demand for U.S. Treasuries, given that the U.S. Federal Reserve was also a large buyer in those securities, as well as demand from indirect bidders, which is broadly the other central banks. But given that other central banks uh, are also facing capital outflows and not be in a position to invest very strongly in US treasuries. On the other hand, the Fed is also undertaking quantitative tightening and reducing its balance sheet. It was the heavy supply of US treasuries during the last quarter, which led to many concerns about the supply absorption for the market, and hence we saw steepening in the US bond curve, where broadly the 10-year underperformed compared to the shorter end of the yield curve. That also led to broad movement across the rest of the world, since the US 10-year tends to be anchor for most of the other economies. A strong move in the US also led to yield hardening across the rest of the world as well. This is also very well represented in the US Financial Conditions Index. If we see the left-hand side of the slide, which is the Goldman Sachs US Financial Conditions Index, since July, the index has been going quite rapidly. And from some close to 99.4, the index went all the way almost to 101 in a very short span of time. What it led to was clarifications from the Federal Reserve governors. Number of governors of the Federal Reserve in their public speaking engagements clarified that these tightening of financial conditions are equivalent of rate hikes. And given that the market pricing of various treasuries as well as overall financial conditions of given their tightening, maybe Fed may not have to hike very aggressively, given that market had already done the job for them. So if you look at the market implied policy rates, and this blue line represents the OIS curve on 3rd November, which was up after various speaking engagements, including the FOMC policy. The amber line represents the OIS curve on 30th September, and the green line represents the OIS curve on 31st August. If we compare these three trend lines and see how market is broadly assessing the policy rates to be, and if we look at especially the points on 12 months, there is a substantial downward movement from where the market was pricing interest rates to be on 30th September, on 31st August. So broadly, the caution from the Federal Reserve and the clarification from the various FOMC officials that probably if bond yields continue to remain where they were, that was in effect equivalent of rate hikes, and probably this led to change in market participants' perception that Fed will be hiking in the near policies, and that's what led to this repricing of future interest rate conditions from the market. Coming to India trends. So if we look at domestic inflation rates, overall the trend seems to be encouraging. So if we look at the CPI diffusion index, which is represented on the right-hand side chart of the slide, Basically, broadly, this represents the weight of constituents within the CPI which are exhibiting more than 5% inflation. So, if you look at the broad trend, since 2022, about 60% of total weight of CPI basket was exhibiting inflation of more than 5%, which has now come to around 43%. So, what it reflects is a broad based decline in various inflation constituents. If we look at core inflation also has continued to come down, and in fact it's at its lowest level since April of 2020. So that, and given that food prices tend to be volatile, and headline inflation that we saw in this left hand side of the chart, which is 7.44 and 6.83, was largely driven by unseasonal variation in tomato prices, which are now normalized. We can see that underlying momentum for domestic inflation continues to be on the softer side. And as the seasonally high food inflation goes down, as the in fact in the beginning of September, there was an expectation that the monsoon will be quite weak, but in during September, the stronger rainfall made up for some of the deficit that we saw in August. So broadly better than anticipated monsoon, the decline of seasonally high inflation, as well as this lower core inflation, which is leading to moderation in household inflation expectations as well, because it's also the household inflation expectations which broadly and ultimately feed into the core inflation as well, that bodes quite well for further inflation in FY25. So broadly, barring any major commodity price or any weather-related shock, we do expect inflation to remain well behaved in 2025 as well, and we do not hence expect any major further policy tightening from the RBI, given that now inflation is quite well controlled. If you look at system liquidity, so system liquidity for since mid of September has been on the deficit side, as we can see through this blue shaded area. Broadly, the reason has been the advance tax which went out on 15 September, subsequent GST and other indirect tax related payments, which has led to a significant buildup of government cash balance. And but broadly, what that means is that the government cash balance is outside the banking system, as it usually remains with the RBI. So hence, any buildup in government cash balance, either due to taxation or any other reasons, broadly results in decline in system liquidity. So what's happened because of that is, if you look at the orange line, which is the MIBOR rate, which was broadly hovering around 6.5%, which is the policy repo rate, is now hovering somewhere close to 6.75. So hence it's close to the MSF rate rather than the policy rate because of the tight liquidity. And also, and this is despite the unwinding of incremental cash reserve ratio of about 1 lakh crores by in the first week of October. What also happened during the October policy was that RBI also announced its intention to conduct OMO sales to manage the excess liquidity whenever it comes, which also resulted in hardening of bond yields, because compared to CRR or other short-term liquidity absorption measures, OMO sales not only absorbs liquidity from the banking system, it also adds to the duration supply to the banking system. It also adds considerable uncertainty to the market participants, because when you have expectations of OMO sale, which is basically government selling or RBI selling government bonds from its balance sheet, it leads to a certain uncertainty regarding further duration supply, and hence broadly we tend to see a more weaker market, weaker demand, even despite positive macro indicators. If we look at the fiscal trend for the central government, one of the concerns that many market participants had, especially in the first quarter of this financial year, was that the tax collections were on the lower side compared to the previous fiscal year, and there were concerns that the government may overshoot on its borrowing target in this financial year. But if you look at the tax collections in the second quarter of this financial year have made up for the muted tax collection in the first quarter. So if we look at the gross tax revenue, it improved to 48% of 2024 budgeted estimates, which compares very favorably to 46% in 2023. And it's largely driven by direct tax. So if you see the change, in the first half of FY24 compared to FY23, income tax has grown by 30%, corporation tax has grown by 20%, which is very healthy, very robust. If we look at the GST collections as well, GST collections also are broadly in line with the budgetary estimates. If you look at the expenditure side as well, the expenditure side continues to be capex focused, and even the revenue expenditure is largely in line with budgetary estimates and the trends we saw during last fiscal year as well. So as of now, there is no material risk to FY24 fiscal deficit target. Also, this year we have the benefit of better RBI dividend, as well as, given these trend rates in the direct tax collection, we do expect these inflows to offset the expected shortfall in disinvestment receipts. Mind you, the government had set a target of 51,000 crores from disinvestment for fiscal year 24, out of which as of now, only about 1,000 crores has been realized. So there's a large gap which may not fructify given the lack of pipeline for now. So we do believe that for now, there is no material risk to the FY24 fiscal deficit target. Coming to the trade deficit, this is also quite important as a higher trade deficit keeps currency under pressure and can lead to intervention from RBI, which further tightens liquidity, as well as can keep RBI tighter on the policy to also keep a rate differential compared to rest of the world. But if you look at the trade deficit compared to August 23 as well as compared to September of last year, the trade deficit has reasonably improved from to 19.4 billion compared to 21.7 billion in August 23. If we look at the drivers of improvement, the drivers came from both oil as well as non-oil imports, which saw a broad-based decline. So as we can see, non-oil imports substantially fell from 5.4 billion in August 23 to 39.9, while oil imports also went down from 14.7 billion in August 23 to 14 billion in September 23. So broadly on the trade side as well, things are improving. So both on the inflation as well as trade, overall macroeconomic situation looks much more constructive for India. As we also saw on the fiscal side, even on the fiscal side, given the robust tax collections, there is a very low probability of any borrowing overshoot by the government in this financial year. So overall, things look quite healthy from the external account, from the fiscal account, as well as from inflationary perspective as well. If we look at the shape of the yield curve, and this is the India sovereign curve, if we look at the dark blue line, which is the current yield curve, it's steep till about 2 years, and then broadly it flatlines. There was a slight upward movement in October compared to September. The reasons, like we discussed, was one, there was a disruption, and there were because of tensions in the Middle East, which led to concerns of higher commodity prices. And since that India is a net oil importer, it led to concerns that India's current account deficit may worsen if tensions were to escalate. There was also a concern of OMO sale by RBI, although so far RBI has been selling Government of India bonds on screen, which it has done in the past also, and there has been no announcement since the October NPC policy. Nevertheless, there is now a perception in the market that RBI may conduct OMO sale operations whenever there is a rally or increase in liquidity, and hence that is keeping slightly upward pressure on bond yields. The third reason, like we discussed previously, was overall rise in US Treasury bond yields, given the heavy fiscal as well as concerns for higher for longer rates. So broadly, that led to upward movement across the curve in October 23. What's the result of which is today, if you look at the starting point of bond yields, that looks quite attractive. So if you look at, for example, a 3-year or a 5-year AAA bonds as well, today a 3-year AAA bonds are yielding close to 780, and even 5-year AAA bonds are yielding close to 775, which are quite attractive from investor perspective. That even if the rate cut expectations of the policy expectations were probably get delayed or even not to realize, even then investors, assuming no major mark-to-market shock, are still sitting at a reasonable starting points for accrual at these levels. So broadly, the outlook from our side is that, as we saw on the first slide, the manufacturing activity continues to remain soft. Broadly, the cushion of consumer excess savings, which was built up during the pandemic, it's getting eroded. Given the quantitative tightening by various central banks, the money supply in developed markets is contracting. As a result of which, banks are also tightening lending standards and on top of it, the cost of financing for most of the corporates as well as the households is continuing to rise. And given that there is a general broad view that rates could be higher for longer, and probably the US economy especially could achieve a soft landing, which is basically they will be able to reach their inflation targets without any meaningful slowdown or meaningful recession risk. Any negative surprise on global growth can trigger a dovish repricing of central bank reaction functions. That, in simple words, I mean, right now, most of the market participants are of the view that growth, although it is moderating, it's still not reaching recessionary levels, and probably that's why central banks will have to hold rates higher for longer, and we should not expect rate cuts in the near time. But given that most of the market participants are positioned on those lines, any negative surprise on long-term growth variables can lead to a more dovish repricing, both from central bank as well as market participants. From a local or from an Indian specific perspective, the local disinflationary trend is quite intact, like we discussed in the slide that we saw on inflation. Largely, core inflation remains very well controlled. Even within headline inflation, other components apart from core are also starting to come down. And assuming no major commodity price shock and a normal monsoon, even next year inflation looks to be reasonable and within RBI's target. Of course, there are external risks, especially because of the geopolitical uncertainty in the Middle East, which could lead to pressures on energy prices. But right now, it's as we can also see, the tensions remain contained, and hopefully, it should not lead to any major commodity price shock to rest of the world, including India. And hence, like we discussed in the previous slide, given the reasonably starting level of high real yields, because when we are making an asset allocation, especially on the fixed income, what is also important is to look at real yield. So today, if you look at from a forward-looking inflation perspective, your expected inflation, even as per RBI estimate in Q1 FY25, is about 5.2. And given that, today, even 3-year AAA bond yields are quoting somewhere close to 780 and 5-year around 775, uh, they are offering a very attractive level of real yields. So we are advising investor to consider portfolios with moderate duration, which is broadly portfolios with duration somewhere between 1 to 4 years, which one provide a high level of yields and also an opportunity to participate in capital gains as the interest rate cycle turns. We are not advising investors to go aggressively on longer duration side for now, because there are still some uncertainties both on the growth aspect as well as on various inflation variables as well. Hence we think that from a risk reward perspective, portfolios with moderate duration are quite attractive for investors. Hence investors with a 6 to 12 months horizon can consider allocation to low duration and money market strategies, given that we believe that we have reached a peak of policy rates for now, and investors who have more than 12 months horizon and tolerance for mark to market volatility can consider allocation towards moderate duration categories. Again, so broadly to sum up, despite the risk of escalation in the Middle East, your commodity prices remain low, which broadly reflect that the economic activity is soft. If you look at especially on the manufacturing or global trade volumes, uh, again the momentum remains slightly on the weaker side, given the tightening lending standards, given the tightening money supply because of balance sheet contraction by various central banks, and we do expect economic momentum to continue to remain weak. On from a local side, the disinflationary pressures on inflation, especially on core inflation, should bode well for future inflation going ahead as well. From a fiscal side, tax collections are quite reasonable, and hence we do not expect any major change to the borrowing program. On the external account side as well, barring any major commodity price shock, the current account deficit is expected to be moderate and quite manageable given our high reserves. And hence we broadly believe that the yields today are quite attractive, especially from a starting point. And without taking very high duration risk, investors today can benefit from these real yields as well as from the possibility of capital gains whenever the interest rate cycle turns. So that's broadly, you know, our thoughts. Happy to take up any questions. Thank you.
First of all, a very happy Dhanteras and a prosperous Diwali to all our listeners. And thank you, sir, for this detailed discussion on the month gone by, global macroeconomic developments, and obviously the fixed income outlook. We will now move to Q&A session, and I request all our listeners to put up their questions on the link provided to them. Meanwhile, we have certain questions with us. We will start with those. So the first question is, as India's growth story remains positive amid the global crisis, which areas are you seeing opportunities for HNIs?
So given that we do not expect domestic growth momentum to meaningfully weaken, especially even if in a context where the rest of the world, could continue to see moderation in growth, we do expect that that the tax collections, uh, an overall fiscal deficit should remain quite manageable for government of India going ahead as well. For broadly, whether it's a HNI or it's a institutional or it's a retail investor, what matters for any investor is the time horizon that they have in the market and their tolerance for any mark to market volatility. So if an investor, let's say, has a time horizon of more than 1 year, whether it's a HNI or any other set of investor with a reasonable appetite for mark to market volatility, we are advising investors to consider moderate duration products like short term corporate bond, which are typically run between 1 to 4 year duration, which are offering very attractive real yields, and as well the opportunity to participate in capital gains with very good liquidity as well, because these are all high quality, high credit quality portfolios. So investors have the benefit of reasonable approval, cap possible capital gains in case the monetary cycle turns, as well as decent liquidity. So we do expect investors to consider these strategies.
Right. So the next question is, in October, the RBI announced its intention to conduct OMO sales to squeeze in system liquidity. Now the market is fearing of higher GSEC supply, and GSEC is also trading range bound despite rally in the US Treasuries. So do you feel the RBI is going to do so and yields will rise further? Your views on this?
So in the in the near term, yields could remain volatile as market participants may remain concerned on additional supply through RBI OMO sale. One thing I would want to clarify is that RBI is already doing OMO sales. The only difference is RBI as of now is doing OMO sales on these NDS home screen. During the policy, RBI governor also indicated that they may announce specific auctions to conduct OMO sales, which led to renewed pressure on bond yields. So given that there is an overhang of OMO sale, probably as you rightly said, that yields may remain range bound for a while. But if someone is taking a more long-term view, what I think one has to take into account is where monetary policy, either globally or domestically, is likely to be headed in the next 6 to 12 months. So if the view is that monetary policy locally as well as globally is likely to be headed towards easing in the next 6 to 12 months, maybe growth momentum could slow down from current levels, maybe inflation could further moderate, probably bonds look still constructive. So while there could be a near-term volatility because of OMO sales, but we do not expect material OMO sales. So if you look at the liquidity calculations, as per the liquidity calculations, if RBI wants to keep liquidity neutral by end of March 2024, the additional OMO required could be approximately 50 to 70,000 crores, which is not very material from an overall scheme of things.
Right. So next question is on corporate capex cycle and bank credit growth. So what are your views on the corporate capex cycle and banking credit growth, and consequently the issuance of CPs and CDs in the coming time?
So as of now, bank credit growth continues to be strong. So largely, we believe that ultimately bank credit growth is a function of where the nominal GDP is likely to head. So in periods of high nominal GDP growth, typically we have seen high credit growth as well. Of course, banks also have the benefit of, cleaned up balance sheets, which they have, kind of done a very rigorous assessment as well as recognized all their losses in the last 5-6 years. So overall, balance sheets for the financial institutions are quite healthy, which can, continue this credit growth cycle for a while. On the question about private sector capex, so what we believe is largely that current capex is driven largely by the government of India as well as the state governments. The private sector probably will kick in once their capacity utilization further continues to enhance. At least as of current levels, we are not seeing evidence of major private sector capex for now. And regarding CP issuance, we do not think and that CP issuance and private sector capex have a very strong correlation, because typically when an entity is doing capex, which is typically long term in nature, they tend to use long term sources of financing, which could be bank loans for longer tenor, or could be longer tenor corporate bonds. So we do not think CP issuance depends on the private sector capex. CP issuance largely depends uh, on a steady state basis on working capital requirements of various corporations. And for now, we are not seeing any extraordinary trend for issuance of CPs compared to what we have seen in the last 3 to 4 years. So broadly, it's on a steady state, no major trend to discern either ways.
Thank you, sir. So the next question is related to US data. So with the economic data such as lower than expected non-farm payroll data and high unemployment rate in the US, so how do you see the Fed decision in the next policy meet? I mean, what they are going to do?
So this unemployment data was one of the weakest since markets have started to look at unemployment data since the COVID period, which is 2020. For further Fed cues, even on if you look at the surprise and the revisions that were made for the previous months, they were quite significant for both. From a monthly run rate and even from this whole calendar year. So what basically it means is that the Fed policy is working. Fed can be more confident that whatever they were trying to moderate economic momentum, that is now finally reflecting in the labor market. And as Federal Reserve said, that they are also looking very closely at financial conditions. So as long as financial conditions continue to remain restrictive, there is no major change in inflation forecast. Maybe they will still like to keep rates unchanged in the next policy as well. And probably they will wait for more economic data to take action on either side.
Right. So the next question is, looking at the current scenario, do you think the 10-year bond will continue to be range bound at the current levels? Or if this is so, the rates have peaked, and can investor consider investing in long duration funds? I mean, depending on the current scenario.
So I think we need to distinguish between policy rates and bond yields. So when we are saying that rates have peaked, it's largely meant that the policy rates have largely peaked here, given that we expect inflation to moderate from these levels. Whether investors should consider long duration funds, given that bond yields are can go down in the next 12 to 18 months. I would say the answer is one, given that long duration funds typically, and as the name suggests, run very high duration, there is also an element of higher volatility in these funds. So any investor who's considering long duration funds should also consider that there will be higher mark-to-market volatility during their investment horizon. And usually long duration funds are suggested for broad asset allocation for investors, so that investors who are allocating to fixed income, they can consider some portion of their allocation to long duration funds, but a large part of their allocation should be considered or should for moderate duration strategies such as short term or corporate bond funds categories. long duration should only be considered for a very small part of an investor allocation, and that too for an investor who has the tolerance for a very high mark-to-market volatility.
Thank you, sir. So I'd request our listeners to put their questions on the link. And so the next question we have is the ongoing Israel-Hamas war can lead to a higher crude oil prices. If the oil prices rise from here, it can have a cascading impact on the inflation also. So in such a situation, can the central bank increase the policy rates further? And what are your views on this?
In case the situation were to escalate further, let's say more countries were to get involved, or some supply chain disruption were to happen, there is always a possibility that in the near term, crude prices may go up. In that case, there is an impact on fiscal, because the government may not be in a position to fully pass on all the increase in crude prices, and they may have to take some impact. There is also impact on the current account deficit, because since we are a net oil importing economy, it also leads to higher current account for us. And of course, there is an impact on inflation. Given that higher oil prices can lead to negative impact on all the three fronts, which is your current account, fiscal, as well as inflationary, there is always a possibility that the central bank may have to hike policy rates to anchor inflationary expectations, as well as mitigate the second round impact of high oil prices. But having said that, what matters is the degree of rise in oil prices. So even during 2022, we have seen oil prices going to $100 just after the Russia-Ukraine escalation, but we did not see any major rate reaction either from RBI in terms of liquidity or in terms of interest rates. So I think we have to distinguish between some near-term stress to all these factors because of a supply side shock, or a more long-term sustainable increase in inflation because of these oil price shocks. So as long as the any impact is believed to be short-lived, we probably may see RBI ignoring the same. And also what matters is the magnitude of the oil price rise. So mind you, oil price are right now trading around $80 a barrel. So even a rise to $100 is close to about 20-25% increase from these levels. So we believe that unless and until oil prices really go up more than 100, and that too sustainably, that is something which could worry the government as well as the RBI. But for now, we don't think that even if the oil prices were to go up in the near term, it may lead to any adverse rate reaction from RBI.
Yeah, thank you, sir. The next question is related to GSEC SDL spreads. So yields of the state government bond rose last month, and hence the spread between the GSEC and the SDLs are driving higher. So what are your views on this spread in the near term? How it is going to be in the near term?
SDL spreads have widened compared to the similar maturity government bonds because of higher supply in SDLs in the last 45 days. And that's largely led to these short-term spread widening. Given that now largely the supply is already adjusted and accounted for, we do not expect any material rise from these levels. So if you see in the last 4 or 5 years, what's also happened is because of the shift of the economy from a more unorganized to an organized space, there is a lot of demand from various long-only investors such as provident funds. Also because of very strong demand from insurance companies as well. Either SDLs as well as long-term bonds have seen very strong and decent demand. So we don't expect any material widening from current levels for SDLs as well. And mind you, one also has to see where are corporate bonds compared to SDLs, because SDL, since they're issued by RBI under the aegis of central government, uh, it's ultimately a sovereign risk. So as things stand today, and as we also saw in one of our slides, SDL yields today are comparable to 10-year AAA bonds as well, if you annualize the SDL spread. So from a overall relative value, SDLs look reasonably attractive as of now.
Right. Thank you, sir. So the next question is, RBI has recently issued a 50-year bond. And have mutual funds also participated in these bonds, and in which category of mutual fund, it can benefit from such long dated bonds?
Since the issuance, I think, was only last week, we will not be able to comment that which mutual funds or whether any mutual fund has participated, because that data is not yet public to the best of our knowledge. As far as which category can benefit, see whether it's a 40-year bond or it's a 30-year bond or it's a 50-year bond. These are all very long-term bonds, more suited for long duration funds. Hence, any investor who's looking to allocate a certain portion to long duration funds from an overall asset allocation perspective can consider. Ultimately, it's the fund manager's view on the relative spread between various maturities of GSEC, which drives the duration call, and this call whether to include 50-year government bond in their portfolio or not. But again, to reiterate, these funds should be looked at only from a long-term strategic asset allocation rather than speculating on monetary policy in the near term.
Right. Thank you, sir. So the next question is on the Corporate Debt Market Development Fund that SEBI has recently launched. So how is this new regulation by SEBI to invest in the CDMDF units will impact the debt funds and its investors in general? And will it also affect the YTMs or returns in the long run?
So it's a step in the right direction by SEBI and Finance Ministry, which basically is a step to deepen and provide more liquidity to corporate bond markets in India. As we know right now that the corporate bond market in India is slightly illiquid and not very deep. And one of the reasons behind that illiquidity is that there is no buyer of last resort, or there is no, especially in times of stress, we don't find too many buyers even at distressed valuations. So this fund, which has been established under the guidance of SEBI, is basically the intention is to kind of provide liquidity to the bond market in times of market dislocations. So I don't think in the near term this will have any impact. It's more from a long-term perspective that in times of distress, market participants will be able to use this fund, to generate liquidity, which ultimately is beneficial for investors.
Right, sir. So we all know next year the election is coming. So what are your views on the market volatilities and yields at that time?
So just like previous elections, what matters for the bond market is one, the impact of fiscal policies on inflation, the impact of fiscal policies on market borrowing program. Suppose the elections, whenever the new government were to unveil its policies, the market participants will be watching the new borrowing program for next financial year 2025. And also if there is any major change in the spending pattern towards more, revenue expenditure, which could have major inflationary pressures. So I think broadly, more than the government, it's the finer print of the budget which market participants will be watching for, and hence I think the further cues, uh, as long as far as the bond market is concerned, will I think come from that.
Right. So our next question is Morgan Stanley has upgraded India to overweight and downgraded China, and citing favorable valuations and strong growth outlook. So what does it mean for FIIs? How they are looking to park their money in India?
Yeah, I think as far as to the best of my knowledge, that's largely related to equity market. And I think this particular investment bank, I'm sure, uh, just like any other investment bank, they may have views or counter views on India or any other economy. Uh, as far as I think FPI allocation to Indian bond market is concerned, it's largely a view on the domestic drivers of economy, which is basically how fiscal consolidation, uh, whether it is happening on the expected lines, whether inflation is close to aligning with RBI's target, and what's comparable yields in rest of the world, what's comparable expected currency volatility in rest of the world, and broad rates in their anchor countries or the mother economies. So broadly, it's an interplay of these factors. So I will not be able to comment on one investment bank's view on valuations for India, because from a bond market perspective, what matters is how foreign investors see consistency in fiscal consolidation, as well as commitment of a central bank uh, to their own inflation target.
Right. So the next question is, the bank FD rates are also offering competitive interest rates, and some of the small finance banks are also giving pretty much attractive rates. So the tax regime has also changed for debt mutual funds. So what is your advice to retail investors? Why they should consider investing in a fixed income mutual funds?
Right. So we believe that when an investor is considering allocation to fixed income, they are looking for safety, they are looking for liquidity, they are looking for income stability, uh, with broad opportunity to participate in some capital gain. Uh, if you look at today and you compare fixed deposits with mutual funds today, given the repricing in bonds as well as money market instruments, today I would say across the curve, real interest rates are quite attractive from a mutual fund perspective. So the starting YTMs of many of the mutual fund categories are looking quite attractive. The second benefit the investor can consider is if they are considering a very, very high credit quality portfolio that also can give them cushion in times of economic distress. Uh, and thirdly, there is also an opportunity to participate in capital gains because mutual funds are mark to market. So if someone has a view that probably interest rates could go down in the next 6 to 12 months, uh, because mutual funds are they basically operate on forward pricing mechanism. That is, they try to reflect future rate rate actions can benefit to market gain. The current yields market or ultra short or the moderate duration product is also quite attractive.
So, thank you, sir. So, dear listeners, we have a constraint of time. So, I'd request you to post questions because we are going to take only one, two more questions. And We will then conclude the call after that. So we have two questions lined up, and the question is, what according to you should be investors' portfolio strategy in the current market scenario?
Thanks, Gulshan. So, like we said earlier, ultimately, investor strategy would depend on their time horizon as well as the risk appetite. So, assuming that they have a risk appetite from mark to market volatility and they have a more than 12 months horizon, they can consider portfolios with moderate duration, given the very, very uncertain economic environment. Right now, we are not recommending investors to go for aggressive duration strategies or aggressive credit strategies. When there is a very good speed spot on the yield curve, just at even 3-4 year points. So we recommend investors to consider funds which are running duration between 1 to 4 years and who are running high credit quality portfolios. Investors who are looking at cash management or temporary parking of the surplus funds can consider money market, ultra short, and low duration funds as well, as they're also offering quite attractive real yields.
So yeah, thank you, sir. And I think we are done with the questions. And I would request our participants to share their suggestions and feedback on the link given to them. We will be happy to take all the suggestions and feedbacks. And thank you, sir, and thank you, everyone. Sir, your closing comments, if any.
Thanks to all our listeners for joining in. Hope you found the session useful and wishing a very happy Diwali to you and your family. May the new year bring you a lot of prosperity and good health. And see you in the next session. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.